At the start of every apocalypse movie, there's always some early signs of things going wrong. Small tremors, strange noises, bubbles on the lake, animals behaving weirdly. Everyone ignores these and goes about their day as normal. And then suddenly, one fine day, 30 minutes into the movie, the earthquake happens, the volcano bursts, the tsunami hits, the meteors crash. And I don't know how many of you are old enough to remember this, but there was a kick-ass end of the world movie some years back called 2012, where all of these things happen at the same time. And throughout the movie, you're left wondering if only someone had paid attention to those warning signs. India's growth came skidding down to below 5.5% in the July to September quarter, when it was expected to be around 6.5%. Now, the government and the RBI have since come out and said, don't worry, we are confident that this is temporary, growth will rebound in the next half of the year. And in fact, overall growth in FY25 will be a respectable 6.5% or so. And maybe they will be proven right. After all, good monsoons earlier in the year should lead to a decent pickup in rural demand. The festive and wedding season in the October to December quarter should help. And the pace of government spending that was slow so far is now starting to improve. But here's the thing. The worrying aspect of the slowdown so far is the underlying theme that India's consumers are struggling, particularly in urban India. You get that sense from company results. You get that sense from auto sales. You get that sense from simply talking to people around you. I see it in the comment section of my videos almost every day. People are increasingly bitter about inflation. They're bitter about taxes. They're bitter about their incomes. And so the finance minister misses the point when she goes on air to passionately defend the talk of GST increase on caramel popcorn.
Salted popcorn, caramelized popcorn, plain popcorn. ऐसे स्टेट्स हैं जहां नमकीन के नाम में पॉपकॉर्न सॉल्टेड भी सेल होता है कि नहीं? नमकीन है वो, मगर जब पॉपकॉर्न सॉल्टेड सिर्फ नहीं है, उसमें कैरामलाइज्ड पॉपकॉर्न भी मार्केट में आता है एडेड शुगर के साथ। एडेड शुगर के चीज हर एक में रेट एक है, नमकीन के ऊपर रेट कम है। सो कैरामलाइज्ड पॉपकॉर्न का ट्रीटमेंट के ऊपर सब लोग विस्तार से चर्चा की।
Caramel popcorn was never the point. Instead, it is what the caramel popcorn issue symbolizes, namely how the whole GST system has become so mind-bogglingly complicated and burdensome for an ordinary citizen that he is happy to pin all his problems to the CGST and SGST that follow him around wherever he goes. That is the point. Now, of course, there are also others who think that this is all fear-mongering, nothing is wrong, India remains one of the fastest growing economies in the world, and this is not a slowdown, it's just a temporary soft patch. Now, the way to resolve this is to look at what the data is telling us. The problem, though, is that the GDP data comes out pretty late and is published only once in 3 months. And very often it comes with so many data issues that even economists feel like they've been asked to describe an abstract painting. Add to this the fact that to check if something is a blip or part of a longer trend, you need at least 2 to 3 GDP readings. So with once every 3 months, you would need to wait for at least 6 to 9 months before knowing for sure. That's the equivalent of 2.5 hours already into that apocalypse movie. So what you ideally need are early warning signs. Case in point, RBI's recently released report on financial stability. Now, this is a massive report, close to 200 pages long, released twice a year, and completely unreadable for the general public. I mean, it is the ultimate cure for insomnia. Now, in this report, the RBI does a comprehensive assessment of the state of India's borrowers, the state of India's lenders, and the overall state of India's financial system. And it gives you a fantastic helicopter view to check if there is stress building up anywhere in the economy. And the latest version of this report sounds the alarm on Indian households. Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Aurodeep Nandi, and today we discuss household stress. In particular, how much are Indians borrowing, what are they doing with their loans, are they able to pay them back, and how all of this is impacting the financial system. As always, if you like what you see, please like and subscribe. And if you'd like to contribute, feel free to hover the phone over the QR code or use the Super Thanks button below. First things first, How are households stressed? Well, for one, household debt is rising. When India was getting into the pandemic, it was around 35% of GDP. Now that's close to 43% of GDP. Now the RBI says that, look, don't worry, this is still lower than the levels in other emerging markets, which you can see in this chart. The green bars are the levels in emerging markets, and the black dotted line is what is the case for India. But despite this strategically colored way in which this chart is presented, it still doesn't mask the fact that Indian households are borrowing a lot more than they were doing 4 years or so back. An increase in borrowing by around 8% of GDP in such a short time is not a joke. Even 1% of GDP is a huge thing, let alone 8%. Now, you could be like, that's okay, Arudeep, financial inclusion is happening, more people are getting bank loans, but they must be using it to buy assets like homes and vehicles, and that is good for the economy. So that's okay, right? Well, here's the thing. The share of borrowers doing that is using loans productively to buy assets, that share is actually falling. Instead, more and more Indians are using loans for consumption purposes, like credit cards and unsecured personal loans, the ones that come with phone messages that you are pre-approved for a 50,000 rupees loan, no questions asked, no collateral needed. You typically don't buy assets with those loans. You essentially run your life with them. In the chart, the red bars denote the share of loans for acquiring assets, and you can see that it is narrowing. Meanwhile, the yellow bars, which is the share of personal loans, credit card debt, EMIs to buy electronic appliances, that share is increasing. In fact, when you look at what subprime borrowers, so people with poor credit scores or bad credit histories, when you see what they have borrowed, nearly half of those loans are for consumption purposes. Meanwhile, in the case of super prime borrowers or better off borrowers, over 60% of their loans are for buying houses and vehicles, that is, for creating assets. So you can sense a divide. People at the top are borrowing to create assets that will most likely generate returns for them, will add to their financial security. The financial security that is unavailable for most of the people at the bottom, who find themselves trapped in consumer loans. Some of this could be reflecting Indians wanting new, sparkly things, particularly after the pandemic when there was a lot of pent-up demand. And some of this could be Indians that have bought those new sparkly things and now are struggling to pay back and are borrowing to service their existing loans. Some of this could be people simply struggling to make ends meet and hence increasingly relying on such loans. And some of this could reflect sheer stupidity. RBI has flagged that SEBI estimates suggest that there are over 1.1 crore individual future and options traders in India. And of them, over 90% have incurred an average loss of around 2 lakh rupees in 2023-24. And what bends your mind is that a majority of these traders have their declared annual income at less than 5 lakh rupees. So actually most can't afford these losses. So for a variety of reasons, Indians have binged on more consumption loans. Are they able to pay them back? Well, here's the thing. Around 60% of people who availed a personal loan in July to September quarter already had more than 3 live loans. Naturally, people are now starting to default. You can see how the write-offs of unsecured retail credit, basically loans given without any collateral, the blue line, has risen sharply, much more than the case for loans that have been backed by assets like home loans or car loans. This is also visible in the case of credit to the microfinance sector, the sector that lends to the poorest of the poor. You can see that the share of stressed assets that are 3 to 6 months past the due date has actually risen sharply in 2024. And it seems that the RBI had a sense that this problem has been brewing for quite some time now. So since 2023, the RBI has been observing the build-up in consumer debt with alarm. And it realized that banks and non-bank finance companies were lending to Indian households too fast and too furiously. It was a bit like, shut up and take my money. The problem was that a lot of entities were forgetting to check if they would get back their money. Now, typically any bank or financial institution's biggest nightmare is to formally accept that their customers are defaulting. Because once a loan account is declared a non-performing asset or an NPA, the bank will have to book it as a loss. It will have to set aside more funds to cover for potential losses from NPA. So some entities, especially microfinance companies, were giving the same stressed borrower more loans to pay back existing loans. In the process, saying to the RBI, nothing to look here. Our bad loans are really low. This is from the same banking crisis playbook from a decade or so back, when corporates borrowed too much and they couldn't pay back the banks, and the banks, instead of recognizing the problem and dealing with it, kept postponing it by giving the same corporates more loans to cover their existing defaults. Finally, at the time when the RBI woke up and forced them to declare their bad loans on their balance sheets, it turned out that the Indian banking system was sitting on a massive bad loan hole. Eventually, this sent banks, corporates, and the economy into the economic version of an ICU. So this time, the RBI didn't want to make the same mistake with retail loans. That is, you ignore the stress until it becomes too big to ignore. And so it started going behind non-compliant entities, checking if they are actually ticking all the boxes and are not sort of just skirting over the regulations. RBI also made it more difficult for banks to lend to the retail sector. How did it manage to do this? So let's say a bank wants to give a 10,000 rupees loan. Now, it is forced to keep some amount of money as capital or reserves, let's say 100 rupees. Now, suppose tomorrow the RBI comes and says, if you now want to lend to consumers or lend to, say, a non-bank finance companies, which in turn is lending to consumers, you need to keep not 100 rupees, but 125 rupees in your reserves. Suddenly, the cost of making that 10,000 rupees loan has increased for the bank. It has to lock up more of its capital in the process. And so the RBI has not only tightened enforcement, it's also made it more difficult for entities to give out retail credit. And so now the economy is experiencing the effects of that tightening. There has been a fall in credit inquiry volumes, fall in loan approval rates, fall in overall retail credit growth. And so you're in this unique situation where people are struggling to pay back their loans and they are no longer getting loans as easily, which is, of course, heightening household stress. How is this affecting the overall health of banks? Well, the RBI assures us that as of now, everything is fine. The asset quality of banks are excellent. The gross non-performing asset ratio is at a 12-year low of 2.6%. But according to the RBI stress test, that could go up to 3% in its baseline scenario by March 2026, and it could rise to as much as 5% and above if the macro situation deteriorates. By the way, remember, even if there are defaults happening, there is a process that banks and other finance companies have to go through before officially declaring it a non-performing asset. So some of the stress might show up in these numbers with a lag. Also, some of the entities could be more exposed to retail lending than others, and hence would be exposed more to these toxic loans. So just because the gross non-performing asset ratio for the industry is stable, doesn't really guarantee that everything is hunky-dory. So what does all of this tell us about the state of the economy? Surely the rise in household debt, the rise in household defaults, this isn't happening in vacuum. At some point, the question that the government needs to ask itself is, if the economy is indeed in such a strong place, if incomes have indeed grown and inequality has indeed fallen according to official data and surveys, then why has there been such a build-up of household stress? And in such an unequal way, where it seems that the better off financially secure households are the ones majorly borrowing to create assets, whereas the people in stress are the ones binging on unsecured personal loans. It's a similar story on the consumption side too, by the way, where the better off households are driving growth and those at the bottom of the pyramid are struggling. And so we are seeing a premiumization of everything in India, be it fast-moving consumer goods, be it real estate, be it electronic appliances. Companies are increasingly focusing on their premium customers. And what the RBI report is essentially hinting towards is that a similar premiumization of the credit market is happening now. And we've talked about India's growth problems in detail in a previous video. Please do take a look if you haven't. I'll leave the link in the description. And actually, these latest findings from the RBI adds to that body of evidence which is pointing towards things slowing down. Now, our best hope at this point is that this may turn out to be just a cyclical slowdown. Business cycles tend to go up and then come down, and with it, incomes, employment, consumer demand, debt are like shrieking passengers on this roller coaster ride. But when the cycle is down, the government and the RBI have to step in to cushion that fall. Reduce interest rates, increase government spending, give tax breaks, simplify taxation, cut red tape. The worst thing that could happen is if policymakers instead choose to remain in denial, offer no course correction, and ignore these warning signs. Because the last thing you want is a cyclical problem turning into a more deep-rooted structural one. A very happy new year, and for more such insights, like, share, and subscribe to The Bond Economist.